Hi everyone, welcome to the next installment of Charts in Perspective, where we use charts to dive into the world of economics. I'm Jennifer Nash, an economic and market research analyst for Vetify. Today, we're going to look at the monthly moving averages for the Ivy portfolio and the S&P 500. We're going to start with the Ivy portfolio and briefly talk about what it is before diving into the data. The IV portfolio is based on the asset allocation strategy used by endowment funds from Harvard and Yale. It is an equally weighted portfolio constructed with 5 ETFs that feature a mix of different asset classes, including domestic stocks, international stocks, bonds, real estate, and commodities. By allocating across different asset classes, diversification is achieved and risk is reduced. So now that we know what it is, let's talk about how it is used. The process is quite simple. First, compose a diversified portfolio from each of the major asset classes held in equal weight. Next, compute a moving average of closing prices over the prior 10 months for each fund. Observe the portfolio at the end of each month. When the fund closes out the month below its moving average, sell it and hold cash, repurchasing only when it closes back above its moving average at the end of any subsequent month. But when the fund closes out the month above the moving average, you hold it. So as you can see, this approach requires monthly attention, which is why I updated on the Advisor Perspectives website each month after the close on the last business day. All right, so diving into the data. So now that March has ended, we can look at the updated signals for each of the 5 ETFs in the table shown here. At the end of March, all 5 ETFs closed above their 10-month moving averages, so the signal is to hold each one. The table also shows the percentage above the moving average for each fund. I've highlighted those positions that are less than 2% from a signal to put a little bit of emphasis on those funds that are close to reversing positions, like the IEF and DBC funds. All right, now let's take a look at the broader market. The S&P 500 posted a 5th consecutive monthly gain in March. But just as we looked at the moving averages for the Ivy portfolio, let's examine the S&P 500 through a similar lens. To reiterate, when the monthly close is above the moving average value, you hold. When the monthly close is below, you move to cash. The disadvantage is that it never gets you out at the top or back in at the bottom. Also, it can produce the occasional whipsaw. Nevertheless, a chart of the S&P 500 monthly closes since 1995, like the one we have shown here, shows that a 10-month simple moving average strategy would have ensured participation in most of the upside price movement while dramatically reducing losses. To further demonstrate, here's the same chart, but this time we've used a 12-month simple moving average. By using 12 months instead of 10, the moving average becomes slightly less volatile. Still, we can see that this is just as, if not more, effective in reducing losses. And lastly, we have one more variation to the moving average strategy. This chart shows the 10-month exponential moving average, which is a slight variant to the simple approach used in the previous two charts. In this version, we mathematically increase the weighting of newer data in the 10-month sequence. Since 1995, this variation has produced fewer whipsaws than the equivalent simple moving average. However, it was 1 month slower to signal a sell after the two market tops in 2000 and 2007. To summarize, all three approaches flashed a hold signal at the end of March, since as you can see from this table, they are all well above their respective moving averages. Timing works because of a basic human trait. People imitate successful behavior. When they hear of others making money in the market, they buy in. Eventually, though, the trend reverses. It may merely be because of the normal expansions and contractions of the business cycle, and sometimes the cause is more dramatic, like an asset bubble, or a major war, or a pandemic, or an unexpected financial shock. However, when that trend reverses, successful investors sell early. The imitation of success gradually turns the previous buying momentum into selling momentum. Now, to close out, I want to point out that our illustrations of the S&P 500 are just that, illustrations. We use the S&P 500 because of the extensive historical data that's readily available. However, followers of a moving average strategy should make buy and sell decisions on the signals for each specific investment, not a broad index. Even if you're investing in a fund that tracks the S&P 500, such as the SPY ETF or SPY, the moving average signals for the funds will occasionally differ from the underlying index because of dividend reinvestment. Our illustrations of the S&P 500 exclude dividends. Well, that's all for our discussion on our latest moving average update. Thanks for tuning in, and I hope you found our analysis insightful. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.